Welcome to today's webinar, compiled and produced by the team at biznews.com. All of our webinars are interactive. We encourage you to pose questions to our guests. The more challenging, the better. And the earlier you get the questions in, the better the chance of having them answered. The recording of this webinar will be available later today on the biznews.com channel on YouTube. I should have actually said later tonight, but welcome from wherever you are to our very first hybrid webinar. I suppose we need to put our cameras on there, Stu.
No cardboard cutouts, Alec.
Yeah, no cardboard cutouts. There we go. Okay, well, there's the good-looking guy on the left. I don't know which left that is, but we've actually got. Do you want to just swing your? Yeah, I'll tell you what. I'm going to switch off the presentation. You can see. There we go. We have a live studio audience. I guess that's the way you used to talk about it in the old days. This is the inaugural hybrid webinar here at BizNews. Okay, you can go back and put it on the good-looking guy. Brilliant. I'll take off my headphones. And tonight, thanks very much, family and friends and members of the community who have come and joined us here. It's really for us a very historic occasion. We only moved into our new offices just over a month ago, and we've really been back at work for 2 weeks.
A couple of weeks, yeah.
Yeah. Technically, we are really trying some interesting stuff tonight. We're going to be buying our new shares in the Shift portfolio live tonight to also give you an understanding, or it would help you a little bit on how easy the process is, and we really are pretty impressed with that. Just to before we start off on tonight's presentation, Stu, we got to get the technicals right.
Thanks, Alec. Just for those who can hear my voice and see myself and Alec on the screen, if you can just give me a high five on your control panel on the right-hand side. Excellent, got those coming through. And as always, we do like to be conversational. There's little questions drop down on that same control panel. If you just throw them in there, I'll pass them on to Alec as he runs through the presentation. But all good to go, Alec.
Brilliant. Okay, let's get the slideshow up. There we go. Get us off screen. I know Jeanette gets cross with us when we go off screen, but actually it's more comfortable, isn't it, Stu? Yeah. Compound annual growth rate 20%. It sounds modest, but Warren Buffett achieves about 20%. He's done it for 54 years. We've done it for 7. So I think that's pretty good going. I mean, it's extraordinary. When we first started this portfolio, the idea was that we felt South Africa was going to hell in a handbasket, and Jacob Zuma was ensuring that our economy was going to get smashed. So our view was take money offshore and to try at least to offset the rand depreciation. But when you take money offshore, it's not enough just to put it into dollars. So we decided at that point to structure a portfolio and to really structure it along the lines of I suppose my view. And my view is that the world is changing massively, seismically. We're going from an old economy to a new economy. From it's been called the fourth industrial revolution now. But pretty much you'll find in our portfolio we have what are called exponential shares. So it's those companies that are focused on this massive growth and change from the old world to the new world, and that are growing at rapid rates, 20% plus. The interesting thing is, if you do that, if you grow at 20% plus over an extended period of time, the returns are phenomenal. And just to give you an understanding of this, we have grown this portfolio, the web trader portfolio has grown at just under, as you can see, under 26% compounded a year. So what that means is in the last 7 years, it's gone 26% on 26% on 26%. And that's taken our initial capital in that portfolio of about 2.2 million rand to about 11.5 million rand. That's what compound growth does. Warren Buffett calls it the 8th wonder of the world. And the most important thing is just don't lose money. So that's a little bit of the background. And I will now take you through the presentation. What happened in the last month? Remember that we do this every month. There's been a sharp sell-off of tech stocks. The reason, and you can see that on the picture on the far right-hand side, there's been a decline of over 10% in the NASDAQ. That's where the exponential companies are listed. That's where we focus most of our attention. And Mr. Market, the mythical being who is a manic depressive, Mr. Market never is not reliable. Mr. Market gets terribly excited at times and then terribly depressed at other times. And as an investor, your job is to do neither of those, is to do your homework, make an investment, hold on to it for the long term. And whenever you do buy a stock, make sure that you've done your homework sufficiently that you can hold on to that share forever. Let's keep going. Okay, here's the story. When you look at that chart, you'll see deaths in the United States are nothing like what the infections are like. So there is an argument on the one hand that inflation indeed is now starting to come down in America already, and on the other hand that the Omicron infections is not the data you should be looking at, but at deaths. Deaths are a reflection of what's happening in the hospitals. If the hospitals are being overrun, then there's a problem. Then you've got to go to a lockdown. But if the hospitals aren't being overrun, as we know in South Africa, that is the case, then you are actually in a reasonable situation. And you can then imagine that the economy will get back to normal. Okay. The other thing that affected our portfolio last month was the Rand, which again, if you're looking to buy US stocks, is a very nice thing because the Rand is now down from 16.25 to 15.15. In other words, you're buying a heck of a lot more dollars for your Rands than you did in the past. Okay, so those are that's the background. It's a predictable impact, not surprisingly, on our portfolio. When I bought Purple Capital at R1.33, it was as a result of Charles Savage coming to the BizNews conference in September, and telling us that this was a company that was going ahead. One of our participants went outside after Charles's presentation, and he bought 50,000 rands worth, just like that, because he was so impressed with Charles. I think he bought them at 80 cents. Jeanette also bought at 80 cents as a result of that presentation. It was a while before we could buy in this portfolio at R1.33, but it's now sitting at R3.42. It's been a phenomenal performance for us. I hope that everybody has actually followed that advice, and certainly in the past month, it helped the portfolio a great deal. Aveng has also lifted its head. It's fantastic, fantastically cheap share. It's sitting at a price to earnings ratio of under 4, which means you get your money back in 4 years, and it's still escalating its profits. It's not a construction share in the normal sense of the word anymore. The construction is in mining and primarily in Africa, and mining is booming in Africa. So that's the other, and then they have a big Australian operation as well, and the Aussie dollar has been relatively firm. And then Wilson Bailey, which is picking its head up as well. So those are our 3 winners for the month. But the rest of them, you can see, have all come under pressure, particularly the exponential stocks on NASDAQ. Part of this reason is there's a guru there called Kathy Wood from the ARK funds. And Kathy was a big shareholder in 2U. She was a big shareholder in Spotify, in Netflix, in Tesla. But Tesla's okay. That seems to have held on. She's been forced through big repurchases by her investors, mainly retail investors, to sell some of these shares. The other big shareholder in 2U, incidentally, is a guy called Ray Dalio, who's held up as one of the great gurus of the world. So I know my good friend Manny always ribs me about 2U. He thinks that 2U is and it certainly is down 25% in the past month, is a stock that we shouldn't have gone into. But on the other hand, I'm a great believer that online education is a fantastic area. I think the decline recently has been technical, and it's only 1% of our portfolio. So it's not really something's going to change our address.
So everyone can hear you. They just can't see the slides. So I don't know you're referring to them. I'm not sure if it's the internet or on your side, but I think it might be an internet issue. Sorry. So they can hear you clearly, but not see what you're talking.
You see from, oh no, it's user error. There we go.
Okay.
Thank you. You see, I told you this was our first run. Can you see the slides now on that side? It'll come in like 2 seconds, I'm sure. Okay.
I've got some questions if you want.
Okay, let's hit the questions.
Okay. Please help us understand why Xero is falling this so much. It seems to do this every 12 months.
Xero's a accounting company, accounting software company, something that we use ourselves here at BizNews. And anybody who's used the Xero software will know that it is superior. They've conquered New Zealand where they started. They've conquered Australia. They're starting to move into the UK and the United States. But it is an exponentially growing company. And exponentially growing companies have had difficulties in when Mr. Market gets depressed. So Mr. Market has been selling a lot of companies like Xero. And although Xero is listed in Australia, it's also listed in the United States as well. So that's been the reason for it. When you buy a company, you should be buying, remember you're a co-owner of the business. And Xero is one of those businesses. If you look at it, it's still growing at around 20% a year, its revenues. It hasn't really caught hold yet in the US and in the US at all. And the UK, it's starting to give Sage, which is the market leader there, good hiding. Here in South Africa, we can see Sage was very big in South Africa, and Xero has completely wiped out Sage not completely, but it certainly has accelerated very aggressively in its market share here, which you can then kind of extrapolate possibly to other parts of the world.
A question from Mark, Alex, is if you look at a graph of 2 year, it goes from the top left to the bottom right over the last 3 years. He says, what's the investment case?
The investment case is that the investment case is, there's a couple of reasons for it. First of all, they are well capitalized. They've got enough money. They are profitable. They are the world leader in online education for tertiary institutions. They recently made an acquisition of a company called edX, which was started by Yale and Harvard universities, and it started as MOOCs. If you know what that is, it was free. It's free education to anybody anywhere in the world who wants it. And the reason why there's skepticism is a concern that they might have overpaid for edX, and in fact, they might not be able to integrate it into 2U. If you have a look at NASPAS, they have got a similar company in the United States, which is smaller, which was valued on their books at over $3 billion. So the whole market cap of, well, edX was purchased for $800 million, so a lot cheaper than the NASPAS company. So I think that it's just one of those things, if you don't like it, don't buy it. Nobody forces you to buy this, but I must warn you as well, is that I'm usually too early in pretty much everything. We bought Amazon at $327. Amazing to think of that. It's now $3,000, but it went down subsequent to our purchase. We bought Apple at $120 before the 5-for-1 share split, so you can work that out. And it went down to $90 and before it recovered. So that tends to happen from time to time.
Thanks, Alex. Just from Pitt, he says, you've been very bullish on Cloudflare. We've already spoken about you. Both have come under big pressure of late. The investment case for Cloudflare?
Cloudflare is my favorite company in the whole world. We are an internet company here at BizNews. We know the value of protection. We had the Zoomers during they took us down twice, I think it was. We've had another guy that we're in a court case with who took us down as well. So we know that if you're going to have a website, doesn't matter who you are, you better have good protection. And Cloudflare is a world leader in protection of websites, and it's very reasonably priced. So they dominate that field completely. It's a field that's growing at 50% a year. If you stop and just take a spreadsheet and work something out of 50% growth, you'll see that it is very, very quickly you get to a level that is almost unthought of, unheard of. As I said in the beginning here, with this portfolio, which has gone from a starting point of 2.3 million rand to 2.3 million rand, and it's now 11.5 million rand, just at a 25% growth rate over 7 years. You can see how compounding will affect. Cloudflare it really is my favorite company. And at $100 a share, we bought it at 20, we sold it at 60, and I kicked myself ever since. And it went to 230, and it's come all the way back now to $90. And it seems to now, common sense seems to be prevailing. So.
Thanks. Like no questions, but the presentation's back online. So
yay! I warned you, we're trying something new today, but at least it is working now. I really hope that our shift works a little later. But just going through the rest of the portfolio, there is QQQ, there is Xero, Netflix, one of my other favorite stocks, is Netflix has got a phenomenal model. It's got probably the new Steve Jobs in Reed Hastings. There's so many books about Reed Hastings now. It feels like he's Steve Jobs because of the way that he manages his company. And another thing here at BizNews, we believe in Reed Hastings' view that no rules. So if you want to have an exponential company, you can't be stifled and stuck in rules, and you can't be sitting there saying, well, value investing is going to come back because growth investing has had a good run, and growth investing is going to come back. Those are simplistic. Find companies like a Cloudflare, like a QQQ, like a Netflix, which is the dominant player in its field with massive runway into the future. And it's down, there we go, down 14, nearly 15%. So Spotify, again, it's a company we know very well here at BizNews. We've just moved our back into Spotify. They've bought a company called Megaphone. So they're vertically integrating, which in the old days, because of antitrust, you weren't allowed to do. And now we're going to test it for ourselves. We're very excited of being able to get onto the Spotify platform. And it's only because we do have a UK operation. They're not in South Africa yet. Amazon's done very well. The revenue, and I'll show you those numbers in just a moment. I went through some of the hard numbers. The revenue multiple is now lower than it's been for a long time. So Amazon's still treating us well, and Apple, as you can see, despite the sell-off on Nasdaq, is still only 5% down. Reason for that is this new thing called the metaverse, which many people are talking about. Microsoft's acquisition of Activision Blizzard, R1 trillion they paid, $70 billion. That deal was done for the metaverse. The metaverse is, if you can imagine, we have the real world over here, us sitting and talking in this room here at BizNews, and then you have the virtual world, which is through the ether when it works. Everybody else who's tuned into this web right now, and the view is that there's going to be an increasing move towards the virtual world or the meta world, and that's really simplistically what it all means. So well positioned for that, and Apple is. The view, a lot of people are getting terribly excited about Apple's products that are going to be plugged into the metaverse. The other thing that they're excited about is Apple's been working on autonomous cars, electric autonomous cars, literally for years. And being the company it is, it doesn't let anything out of the bag until it has to. So that's kind of the breakdown. There we go. There's the portfolio, down 6% in this month. In dollars, down 2%. And the all-share index on the JSE up 6%. So it's been quite a good run for the JSE. And the ran from 1605 a month ago to 1525 last night.
Sorry, Alec, it's not updating again. I'm just not sure what's going on here, but is that on that one? Okay, cool. It's only some of the users who are not getting it, sorry.
Okay, so you say it's not up.
It's updating on some and not others. So I think there's internet connections causing problems on certain computers, but I think we're just gonna have to go on, sorry.
Well, I'll continue to check out. So now Phil.
Yeah. Okay, back, yeah.
Is it back?
Yeah.
Okay. I hope, because on my machine it says it's paused. Apologies. Stu,
Yep.
I'm really hoping that it's going to all work well with
Shift.
Shift. Yes, we're trying. I mean, this is bad enough, but now to try with Shift. Okay, so the value of the portfolio, when that slide does come up,
Yeah, so
you got it.
Yeah.
You can see there. We started off with a rand at 11.47 and 11.27. It's now at 15.25. So the whole thesis of taking money offshore and investing offshore has really, it's worked out. And there's this portfolio as it stands. I've simplified it, I brought it down together, so it's easier to see. I've said to me earlier, your big slide, you can't see it in the back. You can see there we have 23% now in Apple. Apple has actually grown very rapidly in the most recent time. We know it's the first $3 trillion company. Hopefully that's going to update in a minute on your screens. There we go. So it'll come through. And often there's a thought that maybe having 44% of your portfolio in Apple and Microsoft, it's maybe not a good thing. The reason, Apple and Amazon, the reason that I'm happy with that is because we bought them and they've run on, and that's Warren Buffett's view. If you buy a stock, buy it forever and ride it, keep riding it. Had we sold Amazon or taken profits, we certainly wouldn't be sitting here with a 10-bagger return on it. And that's the mistake I made, for instance, with Cloudflare. It's a big mistake I made with Tesla, because we sold Tesla at, well, I don't want to go there because it's really embarrassing, but it's a fraction of its price, because Elon Musk was then fighting with the SEC in the United States. And there were lots of clever people saying, go short on this share, get rid of the share. But it went from, we sold it at $300, and it is now $1,000, but that's after, or 900 or so dollars. That's after it went, you got 4 shares for one. So you just don't want to calculate what that the cost is. But I hope there are people who've actually held on to it. This will show you just how the portfolio has performed in the past months because of the rand strength. The portfolio is down, as you can see, but still, when you take it over the long term, still looking okay. Still looking very, very good, actually. And then similarly, if you look at it in US dollars over the last 2 years, the performance there, because our US dollar portfolio held fairly stable in the past month. This is the web trader portfolio. That's okay. And we've used the opportunity of the sell-off by Mr. Market to buy some more shares. Two of my favorite stocks in this portfolio, Netflix and Spotify, two companies we know very well here at BizNews. And we will be taking the 8% that we have in cash and putting 4% of that in this month and the other 4% next month. You might remember our buying approach always has been that you don't buy it all at once. You try and spread your purchases over 3 months. And especially if you are a rand-based investor, because here you've got the rand taking into account and you've got share price. So you try and smooth that out as much as you can. And that's what we're doing here. We're spending $30,000 of the portfolio as cash, and next month we'll spend the other $30,000. And the portfolio itself, it's impossible to look at, but I think if you're going to get it on the webinar afterwards, you can actually pick up this screen as well. So this is really what happens with Shift. I've logged into Shift. I've put 155,000 Rand into the portfolio, and now I'm going to purchase the US dollars, 10,000 of them. That's okay. So what we are doing, for those of you at home, we are now trying to connect to Shift, and I hope you can see that on your screen now at home, at least. Here at BizNews, it's a delayed reaction, it appears. So we really are trying to get the tech working. What I did, Stu. I think it's user error. Yeah, apologies. So the idea was really to just show you how simple this is to use, but it's only simple to use if you can. Leave the screen. Okay, I'm going to leave it. If it doesn't come on, tough luck. I hope the people at home can see. I want to just check that they can. Please just tell us that you can see the.
It's all good. BN Shift portfolio. I've got 2 yeses. So
Brilliant. Thanks, guys. Okay, so onto shares in the Shift portfolio. And the first purchase we're going to make is QQQ. This is the one. This is an ETF of NASDAQ. And we've got about 35% of the portfolio in there. We're going to purchase another 9. What I've done is I've taken money from rands. I've literally converted it now into US dollars. And now I'm going to buy 9 of this exchange traded fund. The value, the cost is $3,355. Review the order. I accept the conditions. I'm buying 9 shares. It's costing me $15 to buy 9 shares. And I'm confirming that order. Oh,
happening.
Says done.
Yeah.
Right. Okay, so we bought the 9 shares in QQQ, and it's really that simple. Have any of you guys been using Shift? Extraordinary, isn't it? I mean, it really is like world class. The next one we're going to buy is Apple. As you can see, our first tranche of QQQs is down 1%. So we're buying a little cheaper than we bought a month ago. Apple's down 2.6%. So we're buying into this one also a bit cheaper than we did a month ago. This time we're buying 8 of those shares. Review order. Confirm. Okay, done. Amazing, HRT. The guys at Shift have been working on this literally for years. I guess they work for Standard Bank and things move a little slower in these big corporates, but they've put a lot of effort behind it. And what they've done has been quite extraordinary. I haven't seen anything quite as good as this literally anywhere in the world. Okay, next up, our next purchase is Microsoft. We're going to buy 3 of those. Going to cost $931. Review order, confirm. Just think of this. I mean, okay, I started off in journalism on telex machines, where if you wanted to check a story with someone, you had to write it in the telex machine, and they would get it on their side and read it and tell you whether or not it was right. So, gee, I really have come a long way. I mean, we had a Reuters box. It was a Reuters ticker in a wooden box in our office at the Citizen, where I started my financial journalism journey. And whenever the gold price fix was on there, there'd be a little bell, ting, 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 ting. And then you'd quickly go and see what was going on when anything important happened. And now today we are buying shares here instantly in the United States, and I own them. I mean, isn't that like crazy? And then you have a look back at the structure of markets, of companies, and you say, no, you must buy value stocks because value stocks are giving you better returns. Where does the technological benefit come into that argument?
So Julian says you got a good exchange rate there as well, Alec,
Ah,
on your dollars to rands.
Yeah, 15. I think last time we paid over 16.
Yeah.
So it's also nice. Thanks, Julian. I'm happy with that. And then Netflix, one of my favorite shares. We're going to buy 3 of those. This is one that, as you can see, that's pretty cool. It's a pity you can't see it. Can you see it on the screen here?
It is delayed. But
it's delayed, but it'll come through. But again, if we'd bought Netflix yesterday, we could have got it for $5.10. We're now paying $5.22. But that's fine. It's the whole point of this exercise is to do it together. So we're buying 3 of those. Review order. It's going out on the webinar next time. So I suppose the message here is that rather do this from home next time, and you can have your own bandwidth to blame if there's anything going wrong. Okay. Confirm. Then we're going to buy 5 Cloudflare for reasons that were discussed earlier. That's down 23% from a month ago. So now you can look at that and say, are you nuts? why are you buying a share that's like a falling knife? Or you can say, wow, you're getting hamburgers at 23% discount. And I prefer the second lot. So there we go. We've just bought $490 worth of it. Okay. Twitter, that's an interesting stock. Twitter's founder, Jack Dorsey, has been ousted from the company, and the guys who are running it now, unlike Jack Dorsey, are actually more profit-driven. We saw what happened with Uber when Tabasik was pushed out of the company. We've also seen what happened at WeWork when the founder left there as well. So sometimes you need a different type of person for a founder to one who's actually going to run the business into the future. And Twitter is certainly, for my money, one of those. It's down 11% since we bought last month. So we're getting 11% cheaper, and we're buying lucky 13 of those.
Julian says it's also mind-boggling. You can just do it on your phone.
It is. That's why I wanted to experiment here. You know, sometimes it works. Sometimes it's challenging, but we're doing our best. And then Zoom. Zoom is a company that has come into it's not often that it's like Uber and Zoom. I'm going to Uber somewhere, or I'm going to Zoom call you. The value of that from a branding perspective, hey, Thomas, is like, how do you even value it? It's not. Thomas's other name is Dr. Brand, Dr. Oosthuizen. Yeah, now Zoom's gone up today, ish 161, but it doesn't matter. We're still going to buy 3 to put into this portfolio because it comes under the $500. There it is, purchased. We've got 3 more to buy. Just miss. We're going to buy Uber, same one. Uber, incidentally, is up 5% from when we bought it last month. It's the only stock that's actually gone up in our portfolio. So I'm not feeling too happy about paying more than we paid last month on this one. But we're buying 12 of them. And confirm. And we've got 2 more to buy, Spotify and 2. Yes, we are going to buy some more 2Us. So there's Spotify. Spotify, as I mentioned earlier, it's the world leader in podcasting. It's a field that we have invested very heavily in and continue to invest in, and are quite excited about the potential for Spotify. So there we go. Review order. Confirm. I hope there's some guys at home doing the same.
Following you step by
Following
step.
the same step by step, because it really is that simple. And then finally, to you. There it is. That's down 20% since we bought it. So we're getting it for 20% cheaper, and now I've got to buy 30 of them. It's quite a lot of pluses on the. There we go. 485. Ooh, I overdid it a bit. Okay, we might have to go back a little. How cool is that? 468 plus 5. That should do it. Just. Let's see. Oh, insufficient funds. Okay, we'll have to buy 28. I hope. There we go. Okay. Well, that's the live purchases. And just to go back, Stu, now I've got to go out of here. Huh? So what do I do here? Okay, sharing at the top. Go back to PowerPoint. And out of the. Okay. Okay.
Of course.
Yeah, it's finished now. Now you can ask the questions. We've got 2 minutes for questions. Well, sorry, the question for the people at home was, what about timing? There's a perceived risk in the market at the moment that market could go a lot further down. Mr. Market is panicking. When is it you're going to end the panic? There's quite strong arguments about interest rates rising in the United States, and when the Fed starts rising, interest rates start rising, then fixed interest investments become much more appealing than shares, and as a consequence of that, money moves away. But I wrote a book about how to invest like Warren Buffett, and I did a lot of studying there. Went to Berkshire a number of times, probably 7 or 8 times, to go and listen to Warren and Charlie. Went to seminars that they had there. Tried to absorb, try to read as much as I possibly could about the world's greatest investor. And the one thing that he says is, you can't call the big picture. Nobody knows. If you start fixating on interest rates going up or going down, on when there's going to be an increase in GDP and so on, you'll just drive yourself mad. And apart from anything else, that's not actually what investing is about. Investing is about becoming a co-owner of a company. And I get what Buffett said there. Your best investment you can make is in yourself. The second best investment you can make, I think, is in a company of someone like yourself that you really trust and you really like. So with these stocks that are in this portfolio, to me, the human beings find it very difficult to get their heads around exponentiality. If you were to say you had 2.2 million rand in 2014 and it grew at 20% or 25% a year, what would it be worth today? Just off the top of your head, you'll think, well, maybe 4 million, not 11 and a half, because we don't do the most difficult thing, which is a spreadsheet and say, with this company growing at like Cloudflare at 50% annually, what is that going to do to that business in time to come? Because it's hard for us to get exponentiality into our heads. I was very, very lucky. In 2014, the Singularity University came to South Africa. A guy called Stephen Collar, who's quite well known now, the CEO of EOH, was at the time at Barclays Capital, and which became Absa Capital, and they were really struggling to try and get more than after 10% growth in their budgets. So he, in his travels, went to Silicon Valley. He went and engaged with the guys at Singularity University and brought the whole faculty to South Africa. There's an amazing book called Exponentiality. In fact, you'll see it. It's one of the books that I believe in. And it really is a different way of looking at things. Most companies look at life as a incremental increase. You know, if you put in your budget, you're going to do 5 or 10%, and they're happy. Exponential companies don't look at it that way. They look at 10x, 10 times. How are we going to take this company from the size it is today into something beyond our dreams? And there are clear ways of managing a business in that respect. You need to be nimble, you need to be open, you need to be humble. And that's not something that you find in many companies. So when you find a business like that, when you find a Reed Hastings, you find a Jeff Bezos, who puts the customer at the center of his existence, and it's gone through Amazon story. Steve Jobs did the same thing at Apple, and that has gone through the whole Apple company. You know, when you go to, I was at Apple one day at a store in London at Covent Garden, and as I was walking out, the Apple staff all stopped, and they made a line from the stairs all the way down and out, and some guy came down there and they clapped this person all the way up, but cheered and clapped, and he came down and was smiling, and everyone was happy and shaking hands and hugging people, and he went out the store. And I said to one of the staff there, is this guy just been promoted? And she said to me, no, he's leaving us. He's going to another job. But that's the Apple way. He went with our very best wishes because of the contribution he's made. How many companies operate like that? That's Steve Jobs' influence on that business, which remains today. Bezos' influence, even though Bezos is now chairman, it's got the same approach. It's customer at the center. You're never ever going to find a customer who wants to have something more expensive than we can deliver to, or want to have it delivered to them taking longer than the minimum amount of time. So that's what they focus on Amazon. And if you go through the companies in this portfolio, Daniel Ek at Spotify, and he's just like in a different planet when it comes to understanding how to run a business. He's so important to that business that he sets up on 5-year terms. He says, I don't want to get to the end of 5 years and then have to, you guys want to kick me out. I'll give you a 5-year contract and we'll decide after 5 years whether it's a good idea for us to continue. And he's been renewing his contract. He's still in his early 30s. Started that business when he was in his early 20s. And look at Spotify today. So it's these extraordinary businesses, exceptional businesses that you have the ability to become co-owners of. And sometimes the price you're going to buy, the price will be high. And sometimes you're going to buy, like when we bought into Apple at $120 and it promptly went down to $90. So you sell them after you've done your research? No, you do your research first and you hold them forever, except when there is a fundamental shift in that business. That's happened to us. We bought into Metro Bank, which I loved. I'm in the UK. We opened our account at Metro Bank. It's good value. I met the chairman, the guy who started it. He was very successful with a bank in the US. What I didn't know was that his wife was doing all the interior decorating for all the branches and charging a small fortune for it. That then erupted in the media, and when you get one cockroach in the kitchen, there's usually a lot more. We sold Metro Bank as a consequence of that scandal, which is the other thing that Buffett says, when there's a scandal, get out. And we sold at £30 a share, and the share price bottomed out at, I think it was 70 pence. So it lost 99 point whatever percent of its value. It was up at £1 and it got sold out at £1.30. So there are certain rules that Buffett speaks about. He says you don't have to be a rocket science to be a good investor. You just don't get emotional. So now coming back to the question of timing, our view has been from the beginning of this portfolio that we buy month one. You found shares you want to buy. You want to buy them all, but try and stagger it over 3 months. The trouble we had with the shift portfolio, there was only $10,000. So you can't, for instance, certainly not on shift. You couldn't buy fractions. You couldn't done it on these equities. But on shift, who are our partners here, you could only buy whole shares. So we structured it in that way. And my intention from the outset is I said to people, if you can afford it, put $10,000 this month, $10,000 next month, $10,000 the third month. So that eliminate the timing. Is Mr. Market going to get even more angry or scared? Is he going to drop these share prices still more? Well, then it's like if there's a half price, what's it, Wacky Wednesday at Steers. Yeah, Stu knows all about those Wacky Wednesdays. We get 2 hamburgers for $1. Yeah, what a pleasure. I was hoping that we could have bought at yesterday's prices, but we bought at today's prices. It's a 5-year project. I hope that kind of, thank you, John T.
I've got a question from Robert. It's not on the US side, Alec. He wants to know what excites about Aveng.
It excites me. It really excites me. There's a company that has done all the work that you need to do for a turnaround. They were heading into the trash can, and they got a new CEO. They got they had a look at what was in the business, and they rescued they did the hard work. I've done 2 startups. I started MoneyWeb above my garage, and that's the job. You do 1 startup. Most people do 1 startup. That's enough. And then BizNews was also another startup. Well, thanks to Stuart, wasn't quite. And Jeanette, we've been kind of at it now for 8 years. But a turnaround is like a startup. You don't go to sleep at night and think about how you're going to play golf tomorrow. You don't. It has to be all consuming, and they've done that at Aveng. They've trimmed down that business. They've invested in really good companies now that they have. One in Australia, and Moolmans, which is the mining construction company. Africa is a treasure chest of minerals, and most people who own those minerals in Africa want to get somebody else to do the mining for them. enter Millmans.
Thanks, Alec. Gavin just wants to know, how do you know if a stock is value or growth? What's the differentiation between the two?
Yeah, it's again, it's a good question. It's one of those things that the money managers use so they can give you a portfolio that has got certain shares in it that follows according to a certain theme. Traditionally, value is where you can buy the company at less than its liquidated value, liquidated cost price. So you could buy the value, the stock, actually buy the company for 100%, liquidate it, and you'll get more back than the price you paid. That's kind of traditionally value, but it goes into things like banking stocks are value if they're cheap relative to where they were in the past. And then they'll look at price to book ratios, and there's all kinds of complicated things. My view on the world is that the world is changing dramatically. The technology is wiping out costs. It's wiping out middlemen. It's killing whole industries. In my industry, in media, we can see that. We can see what's happened with newspapers. I think the Star, the last I saw, had a circulation of maybe 13,000. When I worked there, was 200,000. And if you've got a business like that, where you are printing, it's wonderful as you're growing it. But as it's contracting, you have the opposite impact. And there are many industries like that that are getting caned technology. Just this simple thing now. We've got 150 people on the webinar at home. We would have had to think of the practicalities of bringing them all together into one room, and the cost thereof would be just astronomical. So again, you get your head around the technology, the changes in technology, the restaurant industry. In the old days, into a restaurant, you sat down, you ordered your food. Today, who's making money in the restaurant industry? It's Uber Eats and Mr. D and dark kitchens. They don't have a front of house. And it's that kind of thing that is changing. Just think of, we've got a partner who have got an Uber for trucks. So logistics. If you want to think of, we all drive to KZN. Well, we do quite often. And you have a look at the trucks on the road. They're not all full. Some of them have got nothing on the back. Some of them have got empty containers. They bring the container to Johannesburg, drop it off, and then they go back empty. Well, imagine a situation where if you are a business and you've got something that you need to get transported to Durban, you go onto Uber, like when we get a taxi, and you can order a truck who would not have to go back to Durban empty again. That cost, or that the deflationary impact of that is just massive. Those are the things that we're still trying to get our heads around in business. But business is changing dramatically, and it's transforming investments as well. So growth stocks theoretically are those who will benefit from the change in business. Value stocks are those that have been knocked down so far that they're cheap.
Thanks, Alec. I don't know if there's questions from the audience. Anyone? Yes.
When the other participants came into streaming of movies, there was a view that Netflix was in trouble, was going to be in trouble because they would take market share. And Reed Hastings was always asked about this at his quarterly conference. That's another beautiful thing about technology, by the way. Go onto YouTube and you can watch all of the quarterly investment feedback live, sitting in South Africa. Okay, Netflix is tonight, I think at midnight. It's a bit late, but the quarterlies are open to the whole world, which of course in the past was just not possible. So we can as informed here as somebody sitting in California. But that his response was always, we as on demand have about 10% of the total market, had a little while ago, and continuing to grow. So although there are competitors that are coming in, they're still not really competing on streaming with Netflix. They're competing with free to air. And if you have a look, talk about newspapers, the most under pressure area in media is network television. These CNNs, but free to air television, even worse, because there's a shift in our industry from on by appointment to on demand. When I was growing up, the whole country would stop on a Tuesday night at 8:30 to watch Alice. If it was there today, we'd be watching a box set when it suited us. So that shift hasn't happened completely yet by a long chalk. Get to shift in easy equities. Both of them are fantastic technologies, far, far cheaper than traditional stockbroking. And as a consequence, they got like they got an elephant to eat. So the investors have woken up to Purple Group, to easy equities. Shift is a too small a part of Standard Bank to really move the dial at the moment. But with the technology they've got, who knows? They could be implementing that in other parts as well. Long answer short, I don't think so. I think easy equities has got such a lot of runway. And what you see what they're doing, they've got fractionalization and low cost, and they're moving into other industries, into other sectors. And why not? Why shouldn't we be bidding for insurance? Why should there not be a platform where if you want to insure your car, you don't go to Hippo where they're all just one company and they, play around with one company's quotes, but you go to a marketplace where all the companies are represented. We tried to do that anyway, by the way, about 15 years ago, and the failed us quite badly. And that was the end of our game change. And the reason for that was after I visited London and I met with Google guys there, they said, I asked them, what would you do if you could go back 5 years? And they said, I would have opened a insurance supermarket. And Doe Stain did that in the UK. And his company in the UK, well, that's really where he made his money. The operation that he started there, and he really is he was ahead of the game there. We tried to do the same thing here, but we couldn't get the tech right. But who's to say that equities won't get the tech right? They're getting it right with property. You can buy, a little share of a flat. Why not?
I can see we almost come up to the hour mark, but there's a question that might excite one of the members in the audience. Niels asks, I don't hear anything about crypto or businesses related to crypto. Why not?
Crypto is not on the platform. If it were on the platform, we would certainly include it in the portfolio. And Jonty, you can take credit for that. I was very much in the Nero Rubini and Charlie Munger camp. It's a big scam, and I never investigated. I have been reading about it, and I think that if only as supporting the libertarian idea of why should central banks decide the value of our means of exchange. I think that, and there are other people who feel that way. When Elon Musk decides to start accepting crypto as payment for his car, you got to know that it's not a fad and that it's not a con. So we just don't have it. There is a proxy for crypto on the US market, but I haven't been able to understand that investment well enough yet to put it in. But yeah, the world is changing, and the most important thing I've found for myself is just to drop the arrogance, because the minute that you look at something and you say, no, it'll never work, my goodness, it's going to bite your bum. Or if you look at something and you say, well, Elon Musk, go short on, well, they go short on Tesla, but get rid of this. He's fighting with everybody, the SEC and so on. Well, it has come back and bit our bums. And Warren Buffett says you should trumpet your failures and be quiet of your successes. And if you can do that in this world that we live in, be quiet about where you're successful, but remind yourself that it's so easy to get things wrong. We'll be a big investor.
Excellent, thanks. I think we can leave it there. Thanks to everyone for joining, and especially the live audience today. I think it's a nice start of something great for BizNews. And yeah, until next month, I think we're going to keep it second last or last Thursday.
Well,
we'll see.
We'll explain this very briefly. Stuart is now running our office in Cape Town. Yes, we've got an office in Cape Town, Barry. Can you believe it? This little BizNews is expanding, and he and the team down there have decided that they can spare him for a week up in Joburg. So he comes up and spends a week with us, and he has selected the second last week of the month. So we will we will have this webinar at 6 o'clock on the second last week of the month, and we will also invite members of the community to come. And just one last thing, and I'm really not joking. How many rooms have we got left at the conference? 23 rooms. Well, that was this morning. So, and I'm sure there were, I saw quite a few things coming through. We have at the Drakensberg on the 1st of March, we have 175 booked. We were only allowed, if you recall, at the last conference to have 50, and we got real clever and had 2 conferences at once, so we had 100. But there's 175 already booked, still 5 weeks to go, and we've got 20 rooms, and I'm afraid that's the capacity. If you're thinking of coming to the conference, wherever you might be around the country, I promise you, you will not regret it. It's a gathering of the crowd. We've got a fantastic lineup of speakers, including Charles Savage, who's coming back because he did us well last time. Hopefully, he's going to do us well again this time. But the others also really top quality. And if you do come to the conference, you will perhaps, if you play golf, draw Decker de Kale, who is Manny, who's undefeated in his last 10 games. So what we do in the golf tournament is we actually draw randomly. So you can end up playing with Clive or Stuart or myself, perhaps, or Michael. But I believe that there is a change to the rules, and the defending champions will have to defend their title. But that'll come at another time. But really do, if you want to come to the conference, please sign up soonest, because we always have a late waiting list, and I'm sure we're going to have one again this year.
Thanks, Alec.